Thank you.
Okay. We also have Aditya Narain, the Head of Research Institutional Equities at Edelweiss, with us. Aditya, thank you very much for your patience. Again, the same question that I asked Ramdev. Is there any butterflies in the stomach about these levels and the rapidity with which? It's not the level as much as the speed with which we have got here.
Absolutely. I think more than the absolute move, I think it's the relative move that worries one a little bit. You know, India has outperformed EM by about 20% over the last couple of months. I think that could be a little bit of a challenge. But otherwise, in terms of direction, I think what you're really seeing is, a profit cycle. I think what is different with this cycle relative to what you saw in 2002, 2003, and clearly in 2010, is that this is a very profit-driven cycle. And to some extent, at the early stages, I think it's relatively easier to value up a profit run, right? I think what you need to watch out for is that this profit run translates into broader economic growth, right? I think if you end up having too much of a disconnect between profit growth and GDP growth or job growth, then you will end up in a situation where that profit growth cannot maintain itself. So I think that's the watch thing over the next couple of years. It's too difficult to time on a quarterly basis, but I think that's what you need to watch out more fundamentally. But otherwise, I think the risks are a little bit more market risk at this point in time, and that too on a relative basis rather than in absolute economic risk.
Okay, Aditya, good morning. So which part of the market do you think you have the maximum risk right now?
Well, I think I would tend to believe from an economic cycle perspective, distinctly, and a little less so from a stock price cycle, it would be in the domestic discretionary demand space. I would be watchful. I think the Diwali season, there are a lot of expectations, and I think that's what you've got to watch carefully. And I say this because I think, as I said earlier, I don't think we have an economic growth run at this point in time. And if anything, it's a little split between the haves and the wealth effect that you're seeing at one end, and the broader market at the other end. And if the broader market is really feeling the pinch that is a possibility, then I think you could get some disappointments. So bottom line, I think the risks would lie a little bit more on the consumer discretionary space, and potentially a little bit in the capex support kind of spaces like cement possibly, where prices have gone up, stocks have done well. And you're not tending to see the kind of demand at this juncture as the prices seem to suggest.
Okay. Then in that case, what is the safe sector?
For us, I think if we were to really split it, I think there are two places that we would position ourselves, and that's how we've been doing it for a bit. One is in the IT space, which I think a little bit Ramdev mentioned, but I think we've been speaking over a period of time. We've been very aggressive in this space for the last 18 months. And I think this is some place where we have a lot of comfort, both in terms of the demand outlook, the ability of Indian companies to get that demand, and relatively limited risks from a stock price perspective. So I think that's one space that we would remain very, very comfortable with, in spite of the move that you've seen, right? The other is really where we are relatively overweight and a little bit aggressive is really in the banking space. You have not seen the credit cycle pick up any level. Traditional economics and traditional market cycles suggest that if you reach such a stage in the economy, both from an economic recovery perspective and from a capital markets perspective, you do start seeing loan growth come back. So if traditionally it holds, I think you will tend to see credit come back. And I think that should be a driver of the sector, which has tended to lag a little bit. Okay. So these are the two spaces where we place the bulk of our emphasis, given where we are, both in the economic cycle and very importantly, as you mentioned a couple of times, in the market cycle.
Okay. Aditya, a lot of money which has been made in stock market is going to real estate, right? I mean, you can see that in the way some of the prices are surging. Do you back it now, real estate?
We actually backed it for a bit. In fact, just about a month ago, which is just something we couldn't have really timed, but we did a fairly big piece really arguing that you are seeing this shift from a demand perspective. The consolidation trend has been on for a reasonable length of time, and you might start seeing the early signs of price, right? So to some extent, I think this is a shift that's going to happen. I think whether one would follow through to the stock performances that you've seen over the last couple of days, I just wait off a little bit on that. But directionally, I think you're in the right space. The risks would lie in terms of the market over extrapolating the pace of this demand or the price effect that people might be factoring in.
Okay. Well, we'll leave it at that, Aditya, but with a rain check from you that we may be calling you soon because the Nifty is barely about 75 points away from another grand number of 18,000. Thank you very much for joining us this morning. Well, let's enjoy while the party lasts, Anuj.
Absolutely, Lata. And you know what? So many stocks hitting new highs. Look at